Warren Buffett is often considered the greatest investor to ever live, but his career has spanned decades and now he's 92 years old, yet he's still actively managing billions of dollars. How is this possible? Well, in the last video, we discussed Warren Buffett's life, how he got his start, who shaped his principles, and the ups and downs of his career into the 1990s. But now let's consider what Buffett has been up to for the last 3 decades. Hi, I'm Sean, and this channel is all about the principles of investing. From stock tips to iconic billionaires, the best strategies, and our favorite tools, the Investors Podcast has everything you need to know. So let's get started. To get a full picture of Buffett's career and success, check out our last video before you watch this one. Let's pick up though where we left off. Buffett began the 90s laser focused on finding the next company for Berkshire to buy. At this stage, he had spent $1.3 billion on Coca-Cola stock, bought a shoe company called Dexter, and had been buying more shares of American Express as well. He had also negotiated to buy 52% of the remainder of Geico for $2.3 billion, giving him 100% control of the company. By early 1996, Berkshire stock had rocketed to $34,000 per share, valuing the company at $41 billion and making Buffett's net worth surge to $16 billion. Throughout the 90s, Buffett saw how having too much debt could lead companies to ruin. Several large companies, including the bank Salomon Brothers, found themselves in serious financial trouble due to leverage, which could potentially cause market contagion. One firm failing can lead to many other firms failing, leading to a financial crisis if public or private bailouts don't occur. When companies handcuffed themselves with too much debt and got into trouble, Buffett would come in with plenty of cash and pick up assets and businesses that were trading for pennies on the dollar. Today's financial climate is pretty similar. There's tremendous uncertainty in the financial markets, and 1 year ago, the 10-year Treasury was yielding 1.5%, but today it's just shy of 4%, while the CPI is over 8%. The potential risk of a contagion unfolding in the financial markets is very real. The best way to position yourself is to carry low levels of debt and hold plenty of cash to take advantage of assets at bargain prices if the opportunity arises. Likewise, those with little to no cash flow and high debt levels may need to sell off their assets to meet their obligation, which is a situation we all want to avoid. At the end of the 90s, Coca-Cola was up 14 times over the decade, which made Berkshire's stake worth $13 billion. By 2000, the stock had a PE ratio of 40, and although he knew the stock was overvalued, he refused to sell any shares. Many question whether Buffett still had the magic touch as he owned 0 technology companies while tech was soaring through the roof. As Buffett prepared to enter the new millennium, the Dow Jones was up 25%, the Nasdaq was up 86%, and Berkshire stock was down 20%. Although criticized for not keeping up with the times, Buffett remained true to himself and stuck to the investing principles that had made him a billionaire many times over. Those principles included buying with a margin of safety, staying within his circle of competence, and remaining patient while Mr. Market's moods shifted. While other investors were chasing the latest hot tech stocks, Buffett remained rational and said, quote, "When it comes to Microsoft or Intel, I don't know what the future will look like 10 years from now, and I don't want to play a game where the other guy has the advantage." As Buffett sat out the dot-com mania, other money managers made and quickly lost fortunes. As he knew, prices eventually reverted to the mean, and by October 2002, the Nasdaq had 53% of its gains wiped out. Buffett gave a speech in 2001 to students at the University of Georgia where he discussed the biggest investing mistakes he had made. Ironically enough, purchasing Berkshire Hathaway and spending 20 years trying to revive a failing textile mill was at the top of his list. He also mentioned mistakes of omission and missing out on big winners such as Fannie Mae and Walmart. These mistakes were due to his cautious approach to investing and only making a purchase if he had a high conviction of it turning out profitably. Buffett also explained to the students his, quote, 20 punches approach to investing. He said, quote, "You'd be very rich if you thought as having a card with only 20 punches in a lifetime, and every financial decision used up one punch. You'd resist the temptation to dabble, you'd make more good decisions, and you'd make more big decisions. The key point is that your odds of success improve when you're forced to direct all your energy towards fewer tasks." Buffett gave another talk at Georgia Tech and was asked what his best investment advice would be. He told the students the best investment they could make in life was in themselves. He encouraged them to never stop acquiring knowledge and to go to bed a little smarter each day. Buffett said the mind is the most powerful weapon to succeed in investing, which is why he spends 80% of his working day just reading and thinking. He also urged them to refine their communication skills, which can, quote, improve your value by up to 50%. One of Buffett's pro tips is to, quote, do work you love and work for whom you admire the most, and you've given yourself the best chance in life you can. One of Buffett's most notable investments was his purchase of Apple shares. For years, he had been known as the guy who never invested in technology, even though the world was becoming increasingly dominated by tech companies. Buffett stated that he didn't view Apple as a tech stock. Like Coke, he made his purchase in the company based on the brand's durability, which was likely to persist well into the future. Berkshire first started purchasing Apple in 2016 after the stock had a sizable pullback due to slowing sales of their iPhones. Buffett saw millions of people using Apple products daily. They loved them and they bought new products every couple of years. According to the 2021 annual report, Berkshire owns 907 million shares of Apple at a cost basis of $31 billion, which now has a market value of roughly $160 billion. The company has been a home run for Buffett and has grown to be approximately 46% of Berkshire's stock portfolio. Not only is Apple a cash-generating machine, but they also are a proponent of share repurchases, two items Buffett loves to see. In 2021, the company repurchased $85.5 billion of its own shares and paid out $14.5 billion in dividends to shareholders. Alice Schroeder rightfully named her book covering Buffett The Snowball. His snowball of wealth started at a very young age when he started selling packs of gum and cans of soda to his classmates and bought his first stock at age 11. He learned the magic of compounding early and knew that he would one day be incredibly wealthy. He continued to invest over the course of his lifetime and found great mentorship in books and people like Benjamin Graham. He was always extremely frugal, knowing that $10 today would eventually become a much bigger sum if he successfully invested it. He was also a learning machine and was singular in his devotion to mastering the art of investing. And finally, he let compounding do most of the heavy lifting for him. As today, he's 92 years old and has accumulated over $96 billion in wealth. Most of us will not acquire this kind of wealth, but we can apply the life lessons and investing strategies to clone the world's greatest investor to ever live. That's it for this video, guys. Thanks for watching. We love hearing your thoughts, so tell us, what are your biggest takeaways from Buffett's career and investments over the last 30 years? Frankly, I had to leave out a lot due to space considerations, so please listen to part 1 and part 2 of Clay Fink's podcast on We Study Billionaires for a much more in-depth discussion of Buffett's career. And if you want to track Buffett's investments for yourself, you can do so with our TIP finance tool in the Legend Investors section. If you didn't watch the first episode in this 2-part series on Warren Buffett, go back and do so now. See you all next time. Berkshire stock is up 3,641,643%, while the S&P 500 with dividends reinvested during that same period is up just 30,209%. The annualized return on that performance is 20.1% per year for Berkshire Hathaway versus 10.5% for the S&P 500. Assuming you had the skills to compound money at 20.1% for 56 years as Berkshire did, you would turn a $1,000 initial investment into an incredible $28.4 million.